Implications of GST 2.0 and anti-profiteering, legal and practical compliance guide, statutory mandate and current legal position. Implications. The GST system in India is set for a shake-up in the future. Early implementation of GST rationalization is to boost consumption during festive season. GDP growth is seen at 6.5% in financial year 2026. GST reforms will do away with some of prevailing uncertainty germane to US tariffs. Next gen GST 2.0 reforms have brought down rates for key items. The government wants to make it all simpler, more predictable, and more compliant. The next generation GST reforms address structural issues, pare down tax rates on essential goods, and support MSMEs. Both businesses and consumers expect a tax system that is more efficient, transparent, and growth focused. GST rationalization effectively moves the median tax rate from 12% to 5%. 391 items have undergone a change. States with higher share of SGST in their revenues could be relatively more impacted due to GST rate rationalization. In the near term, tax devolution to states could be lower by INR 98 billion in financial year 2026, reflecting decline in CGST revenues of the Government of India. GST compensation cess GSTCC is to be discontinued after repayment of back-to-back loans, luxury sin goods to attract special 40% GST rate. Rationalization of GST tax slabs is to dampen consumer price index inflation by at least 25-35 BPS. Hello friends, this is Advocate Sanjay Pahuja. Thanks for tuning in. I welcome all of you to my YouTube channel, Legally Determined. Today's bull session concerns next gen GST 2.0 reforms and anti-profiteering. Today, we explore a paradigm shift in India's indirect tax landscape. With GST 2.0 coming into effect, the long-standing anti-profiteering framework under Section 171 of the CGST Act is set to phase out on 31st March 2025. What happens next? What are the legal duties of businesses when GST rates change, and who will enforce compliance going forward? GST was rolled out in India on 1st July 2017 as one nation, one tax, replacing multiple indirect taxes such as VAT, excise duty, and service tax. The initial GST rollout, often called GST 1.0, sought to unify the Indian market, eliminate cascading taxes, tax on tax, and simplify compliance. GST was termed as a bold reform over value added tax. GST 1.0 had 6 slabs: 0.25% diamonds and semi precious stones, 3% jewelry and precious metals like gold and silver, 5%, 12%, 18%, 28%, and a compensation cess. The 56th meeting of the GST Council was held on 3rd September 2025 in New Delhi under the chairpersonship of the Union Finance and Corporate Affairs Minister Shrimati Nirmala Sitharaman. The GST Council inter alia made the recommendations germane to changes in GST tax rates. GST Council, a constitutional body, cleared the next generation reforms under the 8-year-old GST regime. This paves the way for a broad two-slab structure of 5% and 18% with a demerit rate of 40% rate only for super luxury, sin and demerit goods. What is GST? Goods and Service Tax. GST is a comprehensive indirect tax combining multiple central and state levies into one framework. It has three components: central GST, CGST, levied by the central government on intra-state sales; state GST, SGST, levied by state governments on intra-state sales; integrated GST IGST levied on interstate transactions and imports. Background or what are GST reforms? The lead for GST 2.0 reforms was given by the Honorable Prime Minister Narendra Modi in his 79th Independence Day address on 15th August 2025. The group of ministers GOM on rate rationalization headed by Bihar Deputy Chief Minister Samrat Chaudhary, formed by the Goods and Service Tax Council, has decided to accept the centre's two rate structure proposal for GST and recommended 5% and 18% slabs, eliminating 12% and 28% slabs. The aim of GST 2.0 is lower tax burden on common people with sweeping rate cuts and a reduction in GST slabs, ease blocked working capital, and facilitate ease of doing business with automated refunds and a registration process. 7 pillars of GST 2.0 reforms. Pillar 1, building on the success of GST. One nation, one tax expanded the taxpayer base, simpler, two-tier system, 5% and 18%. Pillar 2, rationalizing rates for fairer taxation, smoother duty structures, faster processing of refunds. Pillar 3, simplifying filing through technology, easy registration for small and low risk businesses, 90% upfront provisional refunds for exporters, digital compliance with e-invoicing, AI driven risk detection. Pillar 4, putting consumers first, essential goods in the 5% bracket, high value items like cars down from 28% to 18%. Pillar 5, empowering MSMEs and manufacturers, fixed inverted duty structure, simpler rates to support Make in India. Pillar 6, stronger states, stronger Bharat, sustainable revenue growth for all states, rationalized rates will increase demand. Pillar 7, lower taxes, higher spending. Families buy more, demand rises, industries grow. Cheaper appliances, electronics will increase demand. A snapshot on inverted duty structure. An inverted duty structure in GST occurs when the tax rate on inputs exceeds the tax rate on output. For instance, in the textile industry, the input tax rate used to be from 12 to 18%, while most finished products are taxed at 5%. This implies that sellers have fewer options for offsetting the cost of input taxes. This situation might result in an accumulation of input tax credit ITC, which can't be used for the output tax liability. The accumulation of ITC due to unutilized ITC will have to be carried over to the next financial year until it can be utilized by the registered taxpayer for payment of output tax liability. This can result in higher tax costs for businesses and or an increase in the hidden tax cost for consumers. To solve this issue, the GST law allows for a refund or reversal of ITC. The refund is determined using a method including the turnover of the inverted rated supply, the net ITC, and the overall turnover. Exceptions where the refund of the unutilized input tax credit cannot be claimed are as follows. Output supplies are nil rated or fully exempt supplies except for supplies of goods or services or both as may be notified by the government on the recommendations of the GST Council. If the goods exported out of India are subject to export duty, if the supplier claims a refund of output tax paid under the IGST Act, if the supplier avails duty drawback or refund of IGST on such supplies, what gets cheaper? Removal of 12% slab Items under this slab shifted to 5% or 18%. Health and life insurance exemption from GST. GST on leather, footwear, textiles, handicrafts, and toys reduced to 5% to boost youth led MSMEs and exports. Essential learning materials like pencils, erasers, and exercise books made GST free to ease education costs. GST on gyms or fitness centers slashed from 18% to 5%, making fitness more affordable and accessible. GST on two wheelers less than 350cc and small cars cut from 28% to 18%, enhancing youth mobility. GST on cement reduced from 28% to 18%, lowering housing and infrastructure costs. Healthcare made affordable with GST on medicines cut to 5% or nil, while health insurance is made exempted from GST. Uniform 5% GST on drones introduced supporting startups and the Make in India initiative. Daily food items like UHT milk, roti, prathas, paneer, and packaged snacks brought under 5% or nil GST, easing household expenses. Electronics and white goods, air conditioners, televisions, fridges, washing machines, cement from 28% to 18%. Fast moving consumer goods, small sachets, for instance, rupees 10 or less, moved to 5% slab. For small cars, GST on small petrol and diesel cars, engine less than 1200cc for petrol and 1500cc for diesel. Length for less than 4 meter reduced from 20% to 18%. Essential items, daily use items including toothpaste, umbrellas, pressure cookers, sewing machines, small washing machines, and bicycles moved to the 5% slab. Sectors benefiting it includes textiles, fertilizers, renewable energy, automotive, handicrafts, agriculture, health, and insurance. Reforms promote affordability, healthier lifestyles, and improved ease of living for youth and households. What gets costlier? Luxury and sin goods now have a new 40% GST rate on items such as tobacco, gutka, and pan masala. Online gaming were reclassified as a demerit good. It has drawn the highest tax rate of 40%. Timeline of GST reforms. On August 15, 2025, Prime Minister Modi announced upcoming GST reforms. Modi promised pared down GST rates before Diwali of 2025. The government, through the GST Council, moved to a simplified tax framework of 5% and 18% with the removal of the current 12% and 28% tax rates from 22nd September 2025 after CBIC notifications come out, except GST on tobacco and its products. GST rate changes on the rest will be implemented from 22nd September 2025. Impact of GST reforms in 2025. The next gen GST reforms do more than just cut rates. 99% of items in the 12% slab moved to 5%, and 90% of those in the 28% slab pared down to 18%. They are expected to create a significant economic impact by fixing inverted tax structure. These reforms free up working capital, improve manufacturing competitiveness, and support Atmanirbhar Bharat goals. For MSMEs, simpler compliance and lower rates can cut costs, increase the formalization of the unorganized sector, and expand the tax base. On the consumer side, cheaper goods have augmented purchasing power. The diminution in prices for white goods should boost demand in the consumer durables sector. The elimination of the compensation cess by March 2026 will help to facilitate both these reforms and make GST an instrument of not just taxation but also economic growth and policy effectiveness. Let's break this down with reference to legal methodology, competition law, consumer protection, and key judicial precedents. Part 1, Legislative Framework and Judicial Principles. Question 1, what is the statutory mandate for passing GST benefits to consumers? Section 171 of the CGST Act 2017 mandates that any reduction in GST rate or benefit of input tax credit must be passed on to the recipient by way of a commensurate reduction in price. Question 2, what is the standard of commensurate reduction? No fixed formula exists. Price comparison pre and post rate reduction must show full reflection of tax benefit to the consumer. Delhi High Court in Racket Bank Kaisar. Question 3, does Section 171 continue after GST 2.0? Yes. Section 171 remains operative beyond 31st March 2025, even though the National Anti-Profiteering Authority (NAA) and Competition Commission jurisdiction ceases after that date. Question 4, is it the end of anti-profiteering regime under GST 2.0? Excess pricing amounts to profiteering. Any GST rate reduction must benefit the consumer through a commensurate drop in price. Section 171 CGST Act 2017. But the National Anti-Profiteering Authority and Competition Commission role in such cases ceases after 31st March 2025. Violations can still trigger proceedings under Consumer Protection Act 2019, Competition Act 2002, Legal Metrology Act 2009. Section 171 of the CGST Act continues to mandate a full and direct flow of tax benefits to consumers. Discounts on pre-packaged commodities are not a replacement for revising MRP. Question 5. What is the enforcement basis after 31st March 2025? Violations may be pursued under the Consumer Protection Act 2019, the Competition Act 2002, Section 171 of the CGST 2017 remains valid. Question 6. Can anti-profiteering be invoked even after NAA, National Anti-Profiteering Authority, and CCI, Competition Commission of India, cease? Yes. Remedies shift under the Consumer Protection Act 2019, Unfair Trade Practice, the Competition Act 2002, Abuse of Dominance or Cartelization. Section 171 remains enforceable. Question 7. What is the leading judicial precedent on profiteering compliance? The Delhi High Court in Racket Bank Kaisar India Private Limited versus Union of India 2024 held that the entire benefit of tax reduction must flow to consumers and unjust enrichment is impermissible. Delay of 4-5 years in initiating action held unreasonable. Question 8. Do anti-profiteering obligations apply even when products are sold at a loss? Yes. Even below cost pricing cannot justify withholding the tax-specific benefit due to consumers. Even if goods are sold at a loss, the tax advantage must be passed on. The legal obligation applies equally to goods and services. Section 171 focuses strictly on tax-linked price change and not on overall profitability. Question 9. Who monitors profiteering? After NAA or CCI cessation, CGST field formations continue monitoring and report brand-wise price comparison to CBIC, Central Board of Indirect Taxes and Customs. Question 10. Does Section 171 on CGST Act 2017 apply to both goods and services? Yes. The obligation uniformly applies to supply of goods and services, including long-term and fixed price contracts. Part 2. Price revision, MRP obligations and legal metrology controls. Question 9. What is GST rate changes? Is immediate MRP revision mandatory? Yes, revised MRP must be updated immediately on all unsold stock under Rule 6, Sub-Rule 3 of Legal Metrology, Packaged Commodities Rules 2011 and DOCA, Department of Consumer Affairs, Circular dated 9th September 2025. MRP revision requirements under Legal Metrology whenever GST rate is revised downward or upward. Revised MRP must be updated without delay on all unsold pre-packaged stock. Question 11. How should revised MRP be displayed? Revised MRP must be affixed through sticker, stamping, or printing without obscuring the original MRP and must be published in 2 newspapers. Question 12. Does this obligation extend to stock where labels cannot be modified? Yes. Dual pricing under Rule 33 of Legal Metrology Packaged Commodities Rules 2011 is allowed until 31st December 2025 or exhaustion of stock. Lower MRP prevails when GST decreases and higher applies when GST increases. If labels cannot be altered due to packaging constraints, Rule 33 of Legal Metrology Packaged Commodities Rules 2011 permits dual pricing, that is, both MRP is visible. Question 13. Can price uptick exceed the rate hike? No. Any excess constitutes profiteering and may invite penalties under consumer law. Question 14. Can discounts replace MRP reduction? No. For packaged goods, discounts are deemed non-transparent. MRP revision remains mandatory. Question 15. Are there criminal consequences for non-revision of MRP? Yes. Section 36 Legal Metrology Act 2009 prescribes fines up to 20,000 rupees and possible imprisonment for repeat violations. Question 16. How are fixed price annual contracts treated? Contract terms cannot override statutory mandate. Benefits must reflect after effective date of GST rate change. Part 3. Sector specific requirements. Question 17. Are pharmaceutical products regulated differently? Yes. Under DPCO, Drugs Prices Control Order 2013 and NPPA, National Pharmaceutical Pricing Authority, mandates revised prices must apply uniformly across batches. The Apex Court of India affirmed this in GlaxoSmithKline Pharmaceuticals Limited versus Union of India. Question 18. Are exports subject to MRP revision obligations? No. MRP rules apply only to domestic retail supplies. Exports are zero rated. Question 19. Are exports subject to Section 171 requirements? Exports are zero rated and not subject to MRP or consumer level price controls. Part 4. Methods of passing on benefits. Question 20. Is extra quantity grammage increase a valid method? Does grammage increase constitute compliance? Yes, for new production. If quantifiable, where quantity addition equals tax benefit and transparently disclosed, as upheld by Delhi High Court in Legal Metrology Rules. Question 21. Is grammage permitted for unsold stock? No. For existing inventory, only revised MRP is permissible. Question 22. Can benefits be passed via free supply? Yes, provided documentation proves the value equivalence of the tax benefit. For new production, industries may pass benefits by increasing quantity or free supply provided the added value equals the tax benefit and records are transparent. For pre-existing stock, only revised MRP is permitted. In service contracts, including AMCs, telecom and software subscriptions, rate changes must be reflected on supplies taxed after the change rate as per Section 13 CGST Act 2017. Credit notes under Section 34 are acceptable where tax reduction is reflected in subsequent invoices. Question 23. Can future supply adjustments, credit notes, be used to transfer benefit? Yes. Credit notes and rebates under Section 34 CGST Act 2017 are permissible with adequate records if the benefit ultimately flows to the consumer. Part 5. Special situations. Question 24. How should long-term service contracts be handled? Tax rate must follow Section 13 of the CGST Act 2017. Timing of supply rules and consumers must receive the benefit of revised rate on supplies taxed thereafter. Contract terms cannot override statutory mandate. Benefits must reflect after effective date of GST rate change. Question 25. Are e-commerce platforms responsible for incorrect MRPs? Yes. Under Consumer Protection, E-commerce Rules 2020, platforms may be jointly liable for misleading pricing. Question 26. Can non-revised MRP be advertised as voluntary goodwill compliance? Yes, but any false or exaggerated claims constitute misleading advertisements under Section 2, subsection 28 and Section 37 of the COPRA 2019. Question 27. Can suppliers advertise compliance as voluntary goodwill? Permissible. However, misrepresentation constitutes misleading advertisement under Section 2, subsection 28 and 37 Consumer Protection Act. Part 6. Investigation, enforcement and penalties. Question 28. Can authorities continue to check MRP compliance? Yes. CGST field officers are directed to submit brand-wise MRP comparison reports to CBIC Central Board of Indirect Taxes and Customs. Question 29. What happens when benefits are not passed to consumers? Authorities may order price reduction, return of undue benefit with 18% interest, penalties up to 10% of profiteered amount, and adverse consumer law orders. Registration cancellation remains possible in severe cases. Question 30. Is unjust enrichment payable to government? Yes. Where consumers are unidentifiable, profiteered amount must be deposited in Consumer Welfare Fund under Section 57 of the CGST Act 2017. Question 31. Can an increased cost, advertising, etc. justify denial of tax benefit? No. Only tax-related reduction must be passed. Other expenses cannot negate obligation. Cost escalation, such as advertising expenditure, cannot justify withholding the tax benefit. Business-related expenses, advertising, logistics, etc., cannot offset tax-mandated price reduction. Question 32. Can suppliers dispute profiteering allegations based on cost factors? Limited defenses exist, such as verifiable cost escalation or valid grammage change. However, authorities apply strict scrutiny. Question 33. What is the reasonable time for initiating proceedings? No statutory limitation exists, but action beyond 4 or 5 years may be held unreasonable as per Delhi High Court in Racket Benckiser Part 7. Remaining obligations when GST increases Question 34. Can MRP be increased immediately on stock when GST rises? Yes. Revised MRP must remain transparent and original price must remain visible. Public advertisement is required. Question 35. Must both prices be visible when tax increases? Yes. Concealing or overwriting original MRP is prohibited under Legal Metrology Act 2009. Question 36. What is the principle governing upward price changes? Upward MRP revision must be strictly proportionate to the GST increase. Any increment beyond the incremental tax violates Section 171 of the CGST Act 2017. GST 2.0 does not dilute the core requirement of protecting consumers against unfair pricing. The legal commands remain. Revised prices must be immediate, transparency be mandatory, full benefit of tax reduction must reach the consumer. Courts and enforcement agencies remain fully empowered to intervene against profiteering or misleading price practices. Part 2. Legal methodology and MRP compliance under GST 2.0. Question 37. What is the statutory requirement for revised MRP after GST rate change? Rule 6, Subrule 3 of the Legal Methodology Packaged Commodities Rules 2011 mandates that retail sale price shall be revised and declared on the package by stamping or putting sticker or online printing without obliteration of the price already printed. Revised MRP must reflect GST impact immediately. Question 38. What is the governing circular for GST linked MRP changes? Department of Consumer Affairs. Circular dated 9th September 2025 mandates affixing revised MRP on unsold stock and public advertisement in 2 newspapers. Question 39. Must the original MRP remain visible after revision? Yes. Rule 6, Subrule 3 of the Legal Methodology Packaged Commodities Rules 2011 requires that the original price cannot be overwritten or concealed. Question 40. Is the dual pricing permitted on transitional stock? Yes. Rule 33 of the Legal Methodology Packaged Commodities Rules 2011 allows both original and revised MRPs until 31st December 2025 or until stock exhaustion, whichever earlier. Consumers must pay a lower price where GST reduces. Question 41. Is the delayed revision treated as unfair trade practice? Yes. Non-declaration or delayed revision constitutes unfair trade practice actionable under Consumer Protection Act 2019. Question 42. Can companies increase MRP when GST increases? Yes, but increase must be strictly proportionate to tax increase. Excess increase constitutes profiteering under Section 171 CGST Act 2017. Question 43. What are pricing rules when GST rate increases? Where GST increases, revised higher MRP applies to consumer, but original MRP must still be visible under Rule 33 of the Legal Methodology Packaged Commodities Rules 2011. Question 44. Can discounts replace revised MRP on existing stock? No. Discounts are insufficient and non-transparent. MRP must reflect GST impact. Question 45. Can discounts be offered in addition to revised MRP? Yes. Provided MRP revision compliance is adhered to fully beforehand. Question 46. Does MRP revision apply to all pre-packaged goods? Yes. Goods covered under Legal Methodology Packaged commodities rules require revised MRP? Question 47. Do automobile dealers need revised MRP compliance? Automobiles are commonly not covered under legal metrology rules for MRP. Discounts are permitted to pass benefit. Question 48. Can grammage change substitute MRP revision? No. For existing stock, for new stock, grammage may be increased to reflect tax benefit if clearly disclosed. Question 49. Are buy X get Y free schemes acceptable? Compliance? Yes, if quantifiable and proved to pass full benefit. Records must evidence value equivalence. Question 50. Is MRP revision applicable to export goods? No. MRP is a consumer retail declaration applicable only to domestic retail supply. Question 51. Can online marketplaces be liable for incorrect MRP display? Yes. Under Consumer Protection E-commerce Rules 2020, platforms are responsible for accurate disclosure and may face joint liability. Question 52. Is mandatory newspaper publication applicable to every rate change? Yes. Public disclosure is part of compliance mandated by DOCA, Department of Consumer Affairs, circular dated 9 September 2025. Question 53. What happens if revised labels cannot be affixed due to packaging constraints? Rule 33 of the legal metrology packaged commodities rules 2011 permits continued sale with the dual price declaration for a limited period. Question 54. Or are penalties criminal in nature? Yes. Section 36 of the Legal Metrology Act 2009 prescribes fine up to Rs 25,000 for first offence and imprisonment for repeat offences. Question 55. Can consumer agencies prosecute for profiteering? Yes. Central Consumer Protection Authority CCPA can act against misleading MRP practice. Question 56. What is the compliance rule for perishable goods? Immediate revision is compulsory unless exempted by legal metrology rules. Price labeling requirements remain automatic. Question 57. Does Section 171 override private pricing contracts? Yes. Statutory benefit mandates override contractual terms. Any reduction in rate of tax shall be passed on Section 171 of the CGST Act 2017. Question 58. Must revised MRP reflect full benefit of tax reduction? Yes. Racket Bankaiser 2024 holds that the entire tax benefit must reach consumers. Partial flow is illegal. Question 59. Does profiteering apply to loss-making products? Yes. Section 171 of the CGST Act mandates price reduction irrespective of margin or profitability. Question 60. Can upward MRP revision occur before GST increase is effective? No. Price alteration tied to tax can occur only from the effective date of amendment notification. Question 61. Are transportation and supply chain costs relevant? No. Only tax-induced changes justify MRP alteration. Any unrelated increase cannot offset the benefit of tax reduction. Question 62. Which agency monitors pricing after GST rate revision? CGST field formations must submit brand-wise MRP comparison reports to CBIC for compliance. Monitoring. Question 63. Can suppliers rely on procedural defenses against legal metrology enforcement? Not if full tax benefit transmission cannot be evidenced. Compliance burden is strict liability in price declaration. Question 64. What is the underlying legal principle governing MRP compliance? Transparency in price declaration, ensures consumer receives correct net tax benefit. Concealment constitutes profiteering and unfair trade practice. We have mulled over next gen GST reforms 2.0 and anti profiteering. Thanks for watching this vid. Please like, share, comment on this vid and subscribe to my YouTube channel Legally Determined by Sanjay Arora.